One of the things I often hear from clients approaching retirement is this: I can't afford to take risk anymore. I'm too old. I'm 2 years away from retirement, or I'm already retired. I don't have the time to make up for market loss like I did when I was younger. First of all, let me say, I understand your concern. After decades of sacrificing and saving, people are afraid of losing what they've built up, and they're afraid it'll hurt them permanently. Now, here's something I want to point out. Just because you're 2 years from retirement or you've already retired, that doesn't mean your investment time horizon has suddenly become zero. If you're in your 50s or 60s, you probably want to be planning on 30 or 40 years left in your life. That's your true investment horizon. So in my experience, when someone says, I can't afford risk, it reflects a lack of a full understanding of the many forms the risk can take. Market risk is the one they're afraid of, but there's also inflation risk, which is another way of saying purchasing power risk. There's longevity risk, or the risk that you live long enough to outlive your money. And there's income risk, the risk that your income won't keep up with inflation and taxes. And the fact is, all of these forms of risk are interrelated and affect one another, because the longer you live, if you live 30 or 40 more years, say, that gives inflation more time to eat away at the real purchasing power of your money. And it makes it harder for your income to keep pace with inflation and taxes. So when someone says, I can't afford risk, what they really mean is, I can't stand to see my portfolio value go down. But here's something that's important to think about. Are you willing to accept a permanent, long-term loss of purchasing power in exchange for avoiding short-term price fluctuations? Let me put it this way. Which is riskier, stocks, bonds, or cash? In the short term, with a portfolio of stocks like the S&P 500, the risk is high. It's going to fluctuate day to day, month to month, quarter to quarter, year to year. But over time, the risk of principal loss diminishes. I often have a conversation with clients when the markets are down. I say, let me ask you three things. Have the markets ever gone down before? Yes, countless times. Did they eventually come back? Yes, every single time without exception. Did they then go on to new highs? And the answer is yes, every single time without exception. Cash, on the other hand, becomes riskier and riskier over time because you're guaranteed purchasing power loss due to inflation. So you can choose to lose money that way, for sure, long term, and slowly grow poorer, or you can choose to endure the short-term price fluctuations in exchange for the long-term growth that stocks have given investors over time, net of inflation and taxes. The long-term average rate of return on a diversified portfolio of stocks like the S&P 500 has been something like 10% per year. But stocks come with the most short-term price fluctuation. They go up and down along the way. Cash has the most stability. It never goes down on your statement, but it's given investors the lowest rate of return. Long-term average on cash is something like 3% per year. Bonds are somewhere in between stocks and cash, approximately 6% long-term average, and an in-between amount of fluctuation along the way. Now let's take out taxes. Let's say with stocks you lose 3% to taxes. Say with bonds you lose 2% to taxes, and with cash you lose 1% to taxes. Now let's talk about inflation. The long-term average inflation rate over our lifetime and beyond has been something like 3% per year. So if we take 3% from the rate of return from stocks, 3% from the rate of return of bonds, and 3% from the rate of return on cash, your long-term net rate of return becomes something like stocks 4, bonds 1, cash -1. So you could say that investing in cash is a great way of growing safely poorer. So I ask you again, which is riskier, stocks, bonds, or cash? Let me ask you this way. If you took $100,000 20 years ago and put it under your mattress, and then you pulled it out today, have you lost any money? You still have $100,000 in units of currency, but we all know you can't buy today with the same dollars what you could have bought 20 years ago. Let me tell you about one couple that I've worked with. When we first met, they felt like they didn't have the time to take on any more risk. They had a very conservative cash and bond-heavy portfolio. But after understanding all the different kinds of risk and understanding the big picture, they were comfortable reallocating to a more diversified, balanced portfolio. Still some bonds, but also some stocks. Enough growth to help keep ahead of inflation and taxes. And by doing so, they were able to give themselves a raise every year so they could keep up with the rising cost of living. They were willing to endure some short-term price fluctuation in exchange for true growth and preservation of their purchasing power. Of course, they'd rather never see their portfolio value go down, but they understand that the downs are temporary, whereas purchasing power loss is permanent. Now, I'm not saying that retirees or pre-retirees should invest recklessly. I'm not suggesting that people suddenly become aggressive, and I'm not suggesting chasing returns or using concentrated bets. That's not prudent investing. What I am suggesting is building and tending a diversified, balanced portfolio that considers your goals, your real-time horizon, and your ability to endure short-term price fluctuations, and that addresses all the forms of investment risk, not just one. Real safety in retirement doesn't mean your portfolio won't fluctuate at all. It means balance. It means discipline. It means having and sticking to a long-term strategy. If you're retired or nearing retirement and would like a second opinion on your portfolio and your long-term strategy, reach out to me. I'll leave a link in the description below, and if you're watching this on a TV, you can click the QR code to schedule a no-cost, no-obligation consultation. What retirement risks are you most concerned about? Let me know in the comments below. And for more on investing and retirement planning, watch these videos next.